Folks, it's Dave Burrows. I am CEO and CIO here at Barometer Capital Management, and I want to welcome everybody tuning in today on the first webcast for September. It's back to school day. For me, it's a strange one. It's the first year I don't have any kids going back to school. So it always feels like the beginning of a new year, and certainly people came in this morning thinking about what they thought going forward, and people wanted to make some changes in their portfolios, a little action in the market. And today we're going to talk a little bit about it. I've got Amit Joshi joining us today. Amit is one of our key portfolio managers on the Canadian equity side. We're going to talk a little bit about financials and some of the bank reports that have come in. We're going to talk some macro, what we see going on out there. It's an interesting market, and it's one that you kind of want to be aware of what's moving, where the money's going, and what may happen on the next little while. So just without any further ado, I'm going to jump in. We continue to think that we're in a structural bull market that started in 2013 in U.S. stocks. And the structural bull market tends to go on a long time, 15, 18 years. And we're about 10 years through. We've had lots of interruptions along the way in the last two secular bull markets. We have been lower bound by the rising 200-week moving average. Been lots of corrections, including the 87 crash and the 1990-91 recession. 1994, the market had a tremendous amount of rotation internally, didn't go down a lot, but went sideways for a year. But in between each of them, there tends to be sort of 4 steps forward or 1 step back. Now, that's perfectly normal. We went through a cyclical bear market from December of 2021 through until January of 2024 when we finally made a new high. Just like the others, we came down, touched on that 200-week moving average. The magnitude of the pullback was about 25%. It lasted just a little over 2 years, and we have been rising since. So we always like to understand the backdrop that we're working against. We don't have to be in every asset class. We don't have to be in any asset class. Our job is to make money. Equity's been a pretty friendly place to be since October of 22. Markets have been rising and they've been broadening since the middle of March in 2023. Just to put it in perspective, I saw this the other day. I thought it was interesting, just quantifying the length of some of the cyclical bull markets, and this would be the most recent one. It feels like the market's been pretty good, but it's very early days. We think we've probably got a couple more years of pretty low volatility returns. Of course, we're going to have corrections along the way, but these things can last a long time, especially when you're in a secular bull market. So when we look at the S&P since the market lows in October of 2022, we've had a series of legs higher. This is the most recent pullback that happened through the month of August, about 9.5%. We know that in a cyclical bull market, you tend to have 2 or 3 5% corrections a year. You tend to have 1 10% correction a year. And about every 18 months, you get a 15%er. I don't think that we're up for that. But the S&P came down about 9.5%, rallied back basically to the highs. Today had a rough day. So the question is, what's driving that? And what do we have to be watching out for? When we look at the Nasdaq 100, which has been instrumental in driving returns in this bull market, we've talked a little bit about this over the last few weeks. Made a high in early July above the most recent trend, and then broke to the downside and broke below the channel that it had been trading in, traded right down to the rising 200-day moving average. Now, since then, that was 16% pullback, rallied about halfway back, and was having difficulty. And we highlighted the fact that the Nasdaq 100, of course, dominated by some of the biggest tech stocks, was showing signs that it may be losing its leadership characteristics. And as many people know, we have had a significant underweight in technology now over the last several weeks, actually a couple of months. And today, Nasdaq 100 had a tough day. I think it was down, last I checked, about 3.3%. Did fail to make a new high. And this calls this group into question. Now, On the other hand, if we look at the equally weighted S&P 500, it actually had a much smaller pullback in the beginning of July, a little over 4%, and over the last 4 weeks rallied and made new highs. So I think that's significant because we like to know what the average stock is doing. We don't love it when it's a small number of stocks driving the market higher. It's unlikely we would have, 30% of our portfolio in 7 or 8 names. And certainly it was down a little today, but again, nothing in the order of magnitude of 3 or 3.3%. Now the S&P was down about 2% last I checked. Equal weight S&P was down 1%. So those big companies are having an impact. Now, it wouldn't be unusual for the equally weighted S&P to outperform for a while. We've gotten used to the idea those big seven stocks are driving a bus. But if you went back to 1958, actually the market cap weighted index beat the equally weighted index only 25 out of 65 times. And on average, the equal weight was outperforming the S&P. So that's something interesting to watch. We've talked a little bit about this over the last few weeks. I do think it's interesting that the value component in the S&P 500 has had 4 great weeks in a row. I do think it's interesting that the mid-cap stocks have come out of a long period of underperformance, started to outperform over the last 4 weeks. So this is kind of interesting. Now, we've been watching the US dollar, and we've talked about the fact that US dollar tends to rally into difficulty. So, of course, US dollar rallied all the way while the market was selling off in 22. It rallied into the lows in March of 23. It rallied into the lows in the market in October of 23. And over the last while, it has been waning. Now, it tends to be that global investors buy US dollars when they're looking for safety. And it also tends to be that they buy US dollars when they think that monetary policy is going to be tighter than other places. And we have started to expect some loosening policy from the US Federal Reserve. And also we've seen money spreading to other parts of the market. Now, US dollar bounced a little over the last few days. Was strengthening a little bit versus pound and euro and yen. However, it is interesting that for the first time since 2021, investors have started to bet against the dollar. That means they're doing other things. And we've talked about Japan doing pretty well. It had that big sell-off a few weeks ago. Look how quickly it bounced back. And in fact, if we look at the Nikkei in US dollars through the lens of the EWJ ETF, as of this morning, we were at new highs. So that's pretty positive. The market in India has been marching its way higher. And we've talked over the last year or so when global stocks start to do a little better, it can go on for a while. And part of the reason may be the sector makeup of the market. These global markets have more financials, they have more industrials. It could be that they are relatively inexpensive relative to US stocks. Certainly the Canadian market, less expensive. And again, that has to do with the components. But after an extended period of underperformance, the Canadian stock market's performing pretty darn well post investors starting to look through the tightening cycle. So we think that that's interesting. I think it's interesting when in an asset class, more and more securities, and in this case, more and more geographic regions are performing well. Really, the only weak market globally right now is China, and they have their own difficulties, and that certainly has been a market that we've been avoiding. But there are some interesting things going on outside of the US market. In fixed income, we think we saw generational low in rates in 2020, like we did in the early 1950s. And we are more likely into a rising rate environment in fits and starts. When economic cycle comes, you see rates rise, and then you get a little slow down the economy, and you get rates pull back to higher and higher lows. When we look at 10-year yields, they went from a low of around 40 basis points to a high of around 4.6%. They've come off a little bit. But I think some people have expected bond yields to come down more. Certainly, actually, the asset class that saw the most flows in over the last year was fixed income. And they've done a little better recently, but they're still a long way off the highs. This is a US Treasury bond, bounced a little bit from the low prices in October of last year, about 10%. But it is interesting. This drawdown in the bond market has gone on a very long time. So in our income mandate, we can go anywhere, and fixed income is a asset class that we can own. We've chosen not to focus in fixed income. Our view was if rates started to come off a little bit, there were other assets likely to do better than bonds. And our job here is to build a portfolio of cash flow generating assets. And these are assets that either are showing us a rising stream of income, which we think is attractive to offset inflation, or securities with improving credit quality, right? Strong balance sheets that would do better than other securities that have weaker balance sheets in the event things are difficult. I think it's interesting when we do a comparison. High dividend paying stocks versus the bond index is clearly outperforming, actually to today making a new relative high. REITs relative to the aggregate bond index over the last 3 months has started to outperform bonds, and that's relatively new. Dividend growth securities, as evidenced by the RDVY ETF, is making new relative highs, and stocks versus bonds in general outperforming over this period. So there's different ways you can build a portfolio for an income investor. Ideally, we want to see a rising stream of income. We're not going to get that in fixed income. It's fixed income. And we also can see some capital appreciation if we believe the economy is okay. Now, if you look at some of the pipelines relative to the bond index, again, significantly outperform. So now we're getting dividends here versus interest, right? Tax is certainly taxed more favorably, depending on the type of account you're holding it in. But there have been lots of options for us to build the portfolio. Now, why is it these things are doing a little better? We think that the market is not discounting a hard landing or a recession, but more likely a soft landing. And these things in a soft landing would tend to do better. Jobless claims have ticked up a little bit, but not a lot. Corporate credit spreads have widened a tiny bit, certainly not showing any kind of credit stress on the market. And when we look at earnings estimates, while the third quarter estimates are being revised lower, and that typically is the case at this time of year, estimates for the year 2024 up about 10%. Earnings estimates for the S&P for 25 up about 15%. And these aren't showing signs of a hard landing. And certainly those security pairs versus bonds aren't showing signs of a hard landing either. So even though we saw a high in yields in October, we'll see how long that goes on for. Aggregate bond index ends up about 10%. The dividend growth ETF's up 31%. The dividend aristocrats or high dividend paying ETFs up 30%. The REIT ETFs are up about 30%. Pembina Pipes up about 35%. And even gold as a safe haven asset, as a defensive asset, is up 30%. So there are other places to focus than fixed income at this point. And not to say that we can't go there, but at this point we've chosen the dividend route. When we get to commodities, commodities had this first big move higher in 2020. They've gone through a tightening cycle. Certainly, they've been chopping around here over the last 4 months now. We'll see whether they get going again, but likely when you have one leg and a consolidation, you're likely to get another. We think that the strongest commodity clearly has been gold. It's up about 21% so far over the course of this year. So it's having a really good move. Today in a weak market, off a fraction of 1%. So acting very defensively. And to highlight, as we have previously, when you go through a long bear market and eventually they gets going, it tends to go on for some time. Gold went through a long period of time where it underperformed. We've been through a global rate tightening cycle. It tends to hold gold prices back. And over the last 4 or 5 months, we've really started to see it lift off. So we think that this looks like a pretty good asset. And in every portfolio, we need offense and we need defense. And gold, we think, is a good defense against things like inflation or stagflation. In fact, gold has the lowest amount of volatility relative to bonds that it has had in the last 45 years. Now, private investors in general have avoided, and part of that has to do with the fact that it hasn't worked for a long time. We can see that central banks have been big buyers, and in July, again, nice big uptick in buying and a contraction in selling. And interestingly, while gold has been moving higher, individual investors have said, boy, I don't believe this can go on. And they've been selling gold. In fact, have the lowest holdings in about 4 years, even though the price of gold is going higher. My guess is that by the time a bull market is done, that will not be the case. But it does mean that positioning is pretty defensive, and certainly investors could out. I highlighted this a few weeks ago. This is plotting gold against the Nasdaq 100. So you can see that from 2001 through 2011, gold outperformed for a decade, and then underperformed from 2012 through until 2020. And since then, interestingly enough, gold is outperforming the Nasdaq. And I think this might be relatively early stages. It's something to watch, and not something to make a decision based on, but certainly something that's an interesting relationship. So it's an asset class that is less volatile now than a treasury bond, and we see that as a defensive diversifier in portfolios. So moving on, crude has been in a consolidation range now over the last 3 months. We're watching this very closely. It sort of needs to hold these prices. The equities in Canada are behaving, not so badly. Certainly, we've seen strength in the big oil producers like Imperial Oil and Suncor. Copper, similarly, broke out of its range, has pulled back over the last 4 months, trading above all of the moving averages. But again, we're at a point where we need to see this start to rally sharply off the moving averages. These, I think, have both been a bet against, a slowing economy, and positioning has been very, very defensive in commodities in general. But we know that both in the case of gold and the case of copper, there'll be very little new reserves found. It now takes between 13 and 17 years to build a new mine. So when you don't find and you're not building mines, there's no new supply coming on. So prices move higher. It could get kind of interesting. But traders are more bearish on commodities now than they have been since early in the bear market in commodities in 2014-15. So positioning certainly, again, can go the other way. If we have people get a little bit more bullish, price moves a little bit higher, it certainly is not a crowded trade. So when we put it all together from the beginning of the year, equally weighted S&P is up about 12%, the TSX up about 13%, the aggregate bond index up 3%. Our income portfolio is up about 19%, equity strategy up about 18%, and global strategy is up about 7.9% since the middle of March when things started to broaden out. The portfolios have really had a good 33% for our income portfolio, 38% for equities, when the global portfolio is up 25.7%. Now, clearly, we don't have to be everywhere. Our strategy is all about picking our spots. And we do believe that 70% return comes from being in the right neighborhood, being in the asset classes that have a tailwind, being in the sectors that have something changing for the better where multiples can expand. And then we try to populate the portfolios by finding the right securities within those groups. And by doing that, we address each of the 3 factors that drive return in the portfolio. Our portfolios are 20 to 30 names, as you know. We don't all work. We hope to get the best securities in the groups that matter in the market. We're not trying to look like the market. But as a big part of our strategy, we try to be very disciplined sellers, and that can be really important from time to time. We like to be in sectors or themes or asset classes when breadth is expanding or more securities are participating in the rally. And on the other hand, when we see breadth deteriorating, no matter how popular the group has become, we want to make sure we are being disciplined around our exits. And so we talked a little bit over the last few weeks about stop losses, and some of them are in technology. When breadth starts to deteriorate, we don't put on new positions, whether it's at the market or in a specific sector. So we always like to follow the leaders, try to identify which sectors and themes are seeing net inflows where breadth is expanding, and we want to focus in those areas. We always look for new leadership to emerge. And over the last few months, we've seen strength in utilities and REITs, high dividend paying stocks. That's a change. That's investors looking for a different type of characteristic. The absence of leadership being more of a defense. So let's talk leadership. Last week, we highlighted that breadth had been improving steadily around the world. And we highlighted that when there is bad news, most often breadth, if it's improving, can act as a shock absorber. So we're going to see. Today was a tough day for the Nasdaq. It had some knock-on effects around the market. But as we talked about, equal weight S&P was down about 1%, where the Nasdaq was down 3%. We know that the percent of stocks in uptrends in the NYSE has been expanding, as it has been in Canada and as it has been globally. The percent of stocks trading above their 50-day moving average over the last week moved higher everywhere. In fact, just about 80% of companies on the NYSE are trading above their 50-day moving average. That's a measure of short-term trend. That means we're getting very broad participation. The percent of stocks with positive weekly momentum or upward trajectory has expanded. Just on Friday, up 13% on the week. Percent of stocks making new highs versus lows is right at the top of the band. Lots of companies making new highs, very few making new lows. And the percent of stocks trading above their 150-day moving average is sitting around 70%. And in fact, the percent of stocks trading above their 200-day moving average, even higher, 80%. So look, we like to see a lot of companies trading with a positive trend. It means you got a healthy market. When we saw deterioration in the market in the fall of 2021, you could see steadily the percent of stocks trading above their 200-day moving average is moving lower, while the index was moving higher, being carried higher by the biggest stocks. That was not healthy, clearly, because look what happened. So I'm not saying that this has to stay here, but it is the hallmark of a bull market where lots of stocks participate. Over the course of this year, we have seen pretty good participation, and certainly the market has been broadening to different groups. One of the things I would watch is to see that this continues to stay above 60%. If it starts to drop below there, that's going to tell us, look, we should be cautious. So we follow these breadth models and we follow them closely because we want to understand when under the surface, things are starting to change. And one of the reasons we do this meeting every week is to show people what we're seeing, to help them understand why we are as invested as we are and why we are focused in the groups that we're focused in. So let's talk about that. Now, this has been an ongoing topic of conversation. The biggest weight across all of our portfolios is financial services. And to jump ahead, it's about 25% of our firm assets. And part of that is because financials went through a very long bear market from 2007 through 2020, broke out, worked their way through this central bank tightening period, and a few months ago started to look beyond it and look at the orderly advance in this group. Now, this is a very broad group. It includes insurance companies, it includes fintech, it includes banks, and of course, includes capital markets banks and regional banks. There's the insurance ETF KIE. This is to today, up on the day and up on the week and up over the last 4 weeks, making relative new highs versus the market regularly. We've talked about some of our bigger holdings. This is Fairfax Financial from about 3 o'clock today, making a new all-time high against a very tough tape. It's the biggest position in the firm. And again, it's just now coming out of a sideways consolidation it's been in over the last 4 months. We've talked about Progressive a number of times in property and casualty. We've talked about Manulife as being a significant holding across this sector. Lots and lots of stocks doing well. In fact, 73% of all the companies in the financial sector are trading at a 20-day high. That's really, really healthy. Right? We've got companies trading above their 50-day, their 200-day moving average, their 20-day moving average, and on a very weak day, held in like champs. When the market sold off 10%, the group went down 4.6, very quickly went on to make a new high. That is the sign of market leadership. Now, we've talked about JP Morgan ad nauseum over the last 2 years. Relative strength versus the market just continued to march its way higher. In fact, today made a relative strength new high again versus the market, off 1.3% against the market down more. But I asked Amit to jump in today because, of course, the Canadian banks have just gone through a reporting period. We have a couple of very significant holdings here. So, Amit, maybe you could just talk to us a little bit about what you think may be driving these banks and the financials in general, and then get a little bit more granular and talk about a couple of these companies.
Sure. Thanks, Dave. I appreciate you having me on. Yeah, I think that's a really good question. The driver for the financials and
Amit, you might have to check your connection. Try one more.
Can you hear me?
Yeah, we're getting a ton of static. Try that again.
How about now? Can you hear me?
No, I think it's not going to work.
Hold on a sec. How about now?
No, I guess we're not going to get them. I don't want to blow everybody's ears out. Amit, I'll drag you on next week. I promise.
How about now? Can you hear me?
Yeah, it's making a lot of static. Amit, I'm going to have to cut it in. Sorry about that. So obviously, Royal reported last week, reported very good numbers, big jump in relative strength. Emmett, do you want to try one more time?
Can you hear me now?
Are you there? Can you hear me?
Can you hear me now?
No. Okay. Well, we tried. We'll try again next week. Royal Bank came in, great numbers across the board. Capital ratio much stronger, and came with very strong numbers in their wealth management business. You can see stocks run up really since earnings, $140, $145, $163. Company's got a great dividend, 3.5, close to double. Sorry, Amit. Every time you turn on your volume, we get an earful of static.
I think.
Yeah. I'm just gonna. I'll try that again. Sorry about that, folks. Commerce similarly reported their numbers. Obviously, market reacted very, very well. Again, big uptick in relative performance versus the market. These Canadian banks in general were really reported very strong numbers. Loan losses were very low, surprisingly. As I mentioned, Royal's wealth management business really, really contributing. So is their capital markets business. Great run up. Down a snip today. But in the face of what's happened over the past week, this really, kind of continues to lead. So financials continue to be a really important part of the market. Industrials. Industrials have been very consistent. 4 straight weeks, 1, 2, 3, 4. Higher, made a new all-time high. Similarly, down 4% off the highs when the market sold off 10. First sign of leadership. Straight back to make a new high. Second sign of leadership. This is the equally weighted index, so it's not being dominated by 1 or 2 companies. It's a very broad index, includes things like waste management. This is the VanEck Environmental Services ETF, made up of companies like GFL, which we own in Canada, and Waste Connections. Again, against a very tough market, making new all-time highs. That is leadership. The aerospace group and defense stocks continue to perform well. And even the transports, the rails are showing some sign of making a turnaround here. So we'll watch those very closely. Materials, surprisingly, with some of the weaker economic data, have held in really well as of this morning. We're trading at a new high. They did back off a little bit through the day. Some areas stronger, gold producers acting pretty well. Some of the agriculture companies acting. But again, this group continues to perform well. Energy is a group that we're continuing to watch. I think that we want to make sure that the leaders continue to perform. This is Imperial Oil. It traded at a new high on Friday, 2.4% yield. They're growing their dividend 20%. They continue to buy back stock. And we think that after coming out of a bear market, like in the most recent period, we think we can get a nice run here, good cash flow being generated. The bull market in energy, I think, is relatively early stage, but as I mentioned, we are at some pretty important support currently. Other groups that have really come on. This is the XLU ETF, which holds utilities. The two biggest utilities in the ETF are the two that we own. We own NextEra, up to 8.7 of 1%. It's a very tough tape. And Southern Company, which was up 3% today to a new all-time closing high. People are looking for these yields and the dividend growth that's coming along with it. Pembina Pipe also up today, 1%, again to a new high. So look, this is a market where there are some haves and there's some have-nots. And we have been through a period of time where there was a small number of stocks driving the market. We've seen over the last few months a broadening out beyond financials and industrials to good solid dividend payers like the utilities and the REITs. That's an expectation that rates are going to come down, but these are way outperforming the bond market. So there's the REITs ETF, RWR, which we own, and we own Silent Property Group. So there's things to do. Pharma, which we've talked about over the last few weeks, continued to move smartly higher, led by companies like Lilly. Lilly was down 0.13 of 1% against a very tough day. Regeneron is performing well. And we have some AbbVie, which also is hanging in pretty nicely. So the have-nots, I guess I have to come back here. The semiconductor group really has come off its course in the last little bit. As many of you know, we stopped our way out of NVIDIA. We owned that for a long time. It was a great return generated. I think there was a lot of people concerned about our exit. We also came out of a couple of other companies in the sector. Big tough down day today. Semiconductors were down 7%. I hate to see a sector make a lower high and then break to the downside. We're here now trading below the 200-day moving average. So this is a good industry. We have a great future in front of us in AI, but we did highlight over the last little while that equal weight and cap weighted on a relative basis, we're starting to underperform. And historically, when the sector got extended a long way above the 200-day moving average, it either consolidated sideways for many months, or it pulled back to the 200-week moving average, which has done a couple of times. And this has just begun. We were 75% above the rising 200-week moving average. It was really ripe for correction. We'll see what happens, but for now, we're going to stay clear. Breadth is weakening. In the Nasdaq 100, breadth is weakening in the semiconductor sector. That means we have no new positions. And it's hard not to, because the future looks very bright for these companies. But technically, I think it's a fairly crowded sector. And we would like to see the technical picture get repaired before we start putting money back to work. Over the past week, financials, industrials, materials, and healthcare, four strong sectors. Infotech down 1.4%. This is prior to today. Obviously, it was a tough day for tech, down a little over 3%. The Sun is down 7%. So when we get to our weightings, financials just about 25% of firm assets, about twice the market weight. Industrials is a significant overweight. Energy continues to be an overweight at about 12%. Keep in mind, over half of this is pipelines. We're there for the dividends. You want to give dividend growth. Technology is about 10%, maybe a little bit less after today. I didn't see whether we get stopped on anything or not, but certainly that's been coming down. It was 14% a month ago, and not too long ago we were market weight. Materials is an overweight, down slightly over the course of the last month. Healthcare has been around a half market weight, specifically in some pharma. We have been avoiding consumer discretionary. That's the one area we think could be weaker with higher rates. We don't have a lot in real estate. We don't have a ton in utilities, although what we have is performing really quite well. So it's an interesting market. We can't forget that we are into a liquidity cycle. Central banks are now easing. It's not about what the economic data is today. It's what it might be in 12 months that matters. We know that earnings estimates for next year are stable and have been estimated at 15% earnings growth. We'll watch revisions. We'll continue to watch credit spreads, and credit spreads still are very benign. We're going to continue to watch volatility, and volatility continues to be in the range that it tends to be in during a cyclical bull market. Volatility tends to stay low, and even though we had this big bump 3 weeks ago, it came right back down into the range, which is very different than any other time when we had an issue over the last few years where it took months for it to come back down the range. So we think that we are in a cyclical bull market. We think that the breadth internals of the market are very healthy. We think that there is money rotating to groups that are less owned and less expensive. Value is performing well relative to growth, relatively uncrowded. Mid-cap stocks look interesting. There's lots to do. When we look at a list that was provided to us by friends of the firm at Strategas, they look at factors that tend to be in place when we get late in a bull market or a bull market top. And when we go down the list, potentially we had a bit of a blow off in technology, so that checks the boxes, but no big inflow into equity market funds, no big pickup in mergers and acquisitions, no big pickup in IPOs. We do have some rising real interest rates, but there's the upward revisions have stayed pretty firm for next year. There is no erosion in the number of stocks making new highs. In fact, that's expanding. We haven't seen a shift toward defensive leadership. And what I mean by that is defensive stocks doing better than the rest of the market, but still going down less. That's not what's happening. Defensive stocks are performing well, as are industrials and financials. And credit spreads continue to be firm. So we watch these things. We watch breadth, we watch volatility, we watch internal strength, and we're very willing to get defensive. But as we come into the fall, at a time when there can be some bumpiness, we think that the backdrop is actually better than what most people think. And as a result, we're pretty firm invested. So I apologize for the audio problems. I'll take a look here and see if we've got any questions that stand out. Oil seems to be under some pressure of late. How are we feeling about our overweight in the income fund? Okay, well, again, when we think about energy, we have to parse it out. And our big weight in the income fund is in energy infrastructure. And then the big dividend paying long life oil producers like Imperial Oil and Suncor. They continue to perform really well. So as long as those groups are performing well, and the reason may be that they generate a lot of cash flow, we'll continue to be there. But we certainly watch the price of oil. We watch the price of gas. Actually, this is the time of year we should start to see natural gas firm up. It was firmer today. So we'll see some of the natural gas producers actually behaving pretty well. But we'll watch it all. And it's saying here, we can hear them, no noise. I sure had a lot of noise here on my end, so I apologize that. Thoughts on CNQ? Same as Imperial Oil, same as Suncor. We would be buyers of all three of those. And we got one more question on this slide. Somebody's raised his hand. Let me just take a look. See if I can find it. You will not be able to find it. Oh, and I apologize. If I'm missing a question, shoot it to us by email or give me a call. I'm happy to jump on. If there are things that we didn't answer today that you'd like answered, reach out to us. We're available. We love to answer questions. We love to talk to people. If you would like a review and we haven't got one set up currently, please let us know and we jump on. It's business time. It's September. We got to make sure that we're filling the days and got lots going on. So we appreciate you tuning in, and we'll do it again next week. Thank you.